Hello everyone, today is Friday, October 6th. I'm Jonathan Casares with Peter Grant. This is our USA Gold Review and Outlook. So over the last couple of weeks, gold has been, more in a consolidative tone. We pulled back from those 1350 levels. Even earlier this morning, down another $7, $8, kind of touched right on that 1260 level. Silver also was under pressure earlier this morning, down about 25 cents, down into like the lowish 16s. But then lo and behold, we had a really quick turnaround. But that initial reaction was really just based on this employment number release. It was a really interesting employment number release because the actual numbers were pretty terrible. Wages increased a little bit, so there was some wage inflation, and I think that the market initially grabbed onto that, but now you're having a complete unwind of that. Silver's up almost 50 cents now from the low, 45 cents from the low. Gold's reversed up $5 now, so you have about a 1% swing in gold just intraday so far. So some really interesting kind of action that we've seen so far today.
Right, and so you're right. The headline number for September jobs was terrible. It was negative 33,000. That's the first negative print in 7 years since September 2010.
Right.
So that's a big deal. And the market quickly dismissed it as a hurricane distortion. But the reality is that the weak expectation number, which was 87,000, factored all of that in.
Right.
And so then it came in substantially lower than that, actually printed negative. But again, they were quick to dismiss it as hurricane distortion and latch on instead to the wage growth. So wages rose 0.5% in September, which resulted in a 2.9% annualized number, which is the highest in 10 months.
10 months
versus 7 years.
I know.
So they're just looking for anything that they could spin as good news, I think.
Yeah.
The reality is, with respect to the non-farm payrolls number, the trend rolled over in that in 2014.
Right.
And so if you look at the moving averages of NFP, and we'll put that chart up for you, but it's been trending down for a while, long before the negative print today and long before the hurricane season.
Right.
So I think it's reflective of labor market weakness.
Agreed. And this is also just, and we talk about this all the time around the office, that up is down, left is right, that nothing seems to make any sense anymore. But, I think it's interesting. So I want to relate this kind of back to the Fed in general, and, Fed speak and the impact of Fed policy and et cetera and so forth, because here we go again with gold, interest rate expectations for December hiking, raising. We're up in the, mid 80s, probably higher at some point this morning, I would think. But anyways, somewhere up there in the 80 to 90% probability they're going to raise rates in December. Gold goes from 1350 down to 1260. It's like this classic repeat of this trade that we've seen every year for the last 3 years. We've covered it ad nauseum. We've talked about how you can even look at the headlines and how they're the same year after year after year, where the same narrative comes rolling out and everything. But what's interesting about this year is, mixed into this bag is there's this huge swell in physical demand. ETF demand is way up. World Gold Council just came out with this big article about German gold demand, way up. And so you have this counter trend. You have this physical demand elevating, and we're seeing it too, but then you have this price going down, which is, I think more of a reflection of where price is discovered, which is in the futures market. And maybe so you're starting to see some of that unwind today too. And I don't know, it's just the context is very interesting to me.
Yeah, like something just doesn't feel right. I mean, you look at the jobs report and you see the terrible NFP number, but wages increase. So somehow that doesn't make sense to me. But to quote one of my old friends from the Merck trading floor, they're going to try and find a pony in the pile. and they've been fairly successful at doing that, putting a positive spin on just about every piece of data, no matter how bad it might actually be.
It's extraordinary how that has held. I'm blown away.
So whether they actually raise rates or not in December remains to be seen. Even looking back to Janet Yellen's speech, which boosted the rate hike expectations from about a 50-50 proposition to a 80% possibility. I read that speech as being quite dovish.
Agreed.
But in fact, opening the door to a reversal of policy, to more of an easing policy.
Exactly.
So, but everybody latched on to the slow and steady rate increases
Yeah.
thing,
are likely warranted, or exactly what the words
Right.
are. But yeah, I mean, it's
So, if the reality is that they are raising rates purely for the purpose of kind of letting some of the air out of these asset bubbles, then maybe they do have to raise rates. But stocks are rising on that too.
exactly. And so I mean, don't get me started, because yes, you're right. So we talk about raising interest rates and asset bubbles and what markets should be reacting to raising interest rates. Because let's talk about this a little bit. Because if you want to talk about what markets have been goosed by the fact that we have an ultra low interest rate environment, nobody's going to argue that it's gold. I mean, gold maybe initially got goosed when it ran up to 1900 during the whole QE phase, and then as soon as they started talking about taper, we had the taper tantrum in gold, and gold lost all of its value. But there's no way on earth that gold is overvalued or should be reacting as much as it is to even this prospect of interest rate hikes. I mean, it's only 0.25% to begin with, so I mean, the interest rate hikes in and of themselves are so small, but even if you just look at what has really been impacted dramatically by low interest rate environment, it is the equities market. It is not gold at all.
Right, or the dollar for that matter. I mean, people are talking, about this big rebound in the dollar, and we're setting like seven-week highs. But you look at that in context with where we were coming from, and the trend is still very much negative in the dollar.
Exactly, and so it's extraordinary. I just feel like if anything should be reacting to this news and to reacting to increased hawkishness, or reacting to, there was this whole pile-on effect when Trump's nominee, sorry, the name is escaping me, his Fed, the guy that they think that is going to...
Cohen?
Yeah, he's going to become the next Fed chair, but he's more of a hawk than Yellen. And so they say, oh, well, Trump's probably going to, nominate Cohen, and then there's more impact to the dollar. And it hasn't even happened yet, and how much more hawkish can you be? And then even if he is more hawkish, why are we focusing on the wrong asset classes as being impacted by that hawkishness? It's gonna drive me crazy.
Don't let it drive you crazy, John.
I'm close. But here's the big takeaway for me, is that we've talked about this in gold forever, is that price discovery is in the futures market and in algorithmic trading, and it doesn't have a brain. And there is this dichotomy that's developing where you have physical demand, you have people looking at geopolitical risk, you have people looking at dollar risk. And I mean, just to go off on a quick tangent there, this whole thing of the China energy exchange and being redeemable in dollars, redeemable in gold, and that started getting away from the dollar and dollar losing its hegemony, and what that's going to look like, and the potential launch of that right here at the end of the year, and actually a gold standard in energy trade, and how extraordinary that could be for gold and for China and for the yuan, and certainly not for the dollar. And so now we have more and more clients for the first time in a year calling and saying, I'm really worried about the dollar. And so that whole narrative is changing. So you have all of this, yet gold falls. And to me, that's all a reflection of the, kind of strange price discovery that we can have in this market at times.
No, I would agree with that. And I would point to the algorithms that say, if in a risk-on environment, if stocks are rising, you sell gold.
Yeah.
And
buy dollars if you have a hawkish Fed speak, and it's just this trade. But what it creates are these just phenomenal opportunities, I feel like, because it is so counterintuitive, and if you agree, then seeing gold and silver down the way they are in the midst of all that is going on, that nothing is different than when gold was $13.50. We're just perhaps slightly quieter. But
no, and it's worth noting the resilience of gold in the face of some of these asset classes setting all-time highs.
Couldn't agree more. And that's actually the giant, undercurrent, if you will, or the thing that nobody's noticing is here you have gold and S&P basically at the same level this year in terms of performance, yet no one would know it. Gardman said that. Gardman was like, if you look at this, if you walk down the street and asked anybody, no one would tell you gold had done as well.
What's the best performing asset class? Stock.
Well, and why wouldn't you think that? Everywhere you look, every TV you turn on, new all-time high. And while that is true, to see that gold has done just as well this year and is nowhere near an all-time high, bells should be going off like crazy. It's so, I think that is a powerful narrative for the gold market, just if you look at it from, if you had two choices, and you had a bull market setting all-time highs that's clearly long in the tooth, that the narrative is evaporating everywhere you look, and you have something that is more of a developing bull market that is doing just as well as that asset class that's hitting all the headlines, that is 40%-ish below its all-time high, which one do you choose?
Well, I have perhaps a slight bias, but
You do,
yeah.
but still.
But even from a just a
Yeah.
basic investor rationality, I'd pick gold at this
Well,
point.
totally. And I mean, it doesn't even have to, we talk about this all the time too with gold. The gold truly is a safe haven. And as you start looking at some of these developments in the dollar and the international geopolitical risk environment, even just treating gold as a safe haven, but to be able to have that safe haven, that currency that can't be printed, match with, what is a strong narrative moving forward. I mean, that's the type of environment we had in the mid-aughts that, made some of the happiest gold owners, in the history of the company.
And some of those gold owners, that perhaps haven't bought since the early aughts are starting to call us up again.
Yeah.
And invariably the rationale behind their thinking very much aligns with what we just talked about.
Yeah.
I've made good money in the stock market. I'm taking some of it off the table and bolstering my gold holdings because I'm worried about a number of things, be it the geopolitical risk, the dollar risk, growth risks, the absence, continued absence of inflation, and if the Fed might actually at some point align their policy with what they say it really is.
Would that be something?
Yeah.
But yeah, no, I hear you, and it is all, it's a very strong, I guess backing of gold ownership in general, and where we all stand and what is all going on out there in the world. So with that in mind, it kind of leads to our golden gong this week, which is Rick Rule. He's the Sprott U.S. Holdings CEO, and he had this to say. The most important determinant of gold prices for the last 40 years has been they have been negatively correlated with faith the U.S. dollar and faith in the U.S. 10-year Treasury. The U.S. 10-year Treasury is, I believe, close to the end of a 35-year bull market. That would suggest gold is much closer to the beginning of a bull market. Amen. Rick Rule. Thank you very much for watching. I'm Jonathan Casares.
I'm Peter Grant.
See you next week.